Hi, my name is Martin Pring, and I'd like to welcome you to this series on how to apply technical analysis to trading and investing. I specifically designed these tutorials for those of you who are completely new to technical analysis. In later sessions, the basic building blocks we're going to cover here will be expanded so that even intermediate and advanced traders and investors will pick up some useful pointers, or even different ways of attacking a problem they hadn't thought of before. First, rather than repeating bonds, stocks, commodities, and currencies all the time, I'll be using the generic term securities as a quick reference that refers to any freely traded entity. So when I use the word security, you can be sure that the principle or technique I'm explaining applies to all these markets. 2. It's very important to understand that technical analysis is an art form that puts together many scientifically derived indicators, none of which is perfect. There is no holy grail. There are no perfect indicators. If that's what you're looking for, click on that close button right now and go no further. In technical analysis, we're dealing in probabilities. So even when there might be a 95% probability of a trend reversal, there's still a 5% probability that it will not materialize. 3. Thanks to computers, it's easy to come up with some pretty sophisticated indicators and techniques. My point is, keep things simple and apply common sense at all times, as simplicity has a much stronger probability of working than complexity, as many folks use complexity as a crutch for not thinking things through. Now, I'm going to be explaining a lot of indicators to you during this course, their strengths and weaknesses, but in the final analysis, it's going to be your money on the line, so it's of paramount importance that you only use the indicators and approaches that you are comfortable with. Finally, technical analysis can do a lot for you if you have the patience and discipline and objectivity to apply the basic principles. That may sound easy, but putting it into practice is a lot harder than you might think. Technical analysis will put the odds in your favor, but like any other worthwhile endeavor, it takes effort and a lot of practice. Remember, all those commercials you see promising fast, risk-free profits are false. Believe me, if the advertisers had found the Holy Grail, they would be using it in the marketplace, not wasting their time promoting it. Okay, so what is technical analysis? First, the art of technical analysis is to identify trend changes at a relatively early stage and to maintain an investment or trading posture until the weight of the evidence indicates that the trend is reversed. Technical analysis works because prices are determined by psychology, and psychology moves in trends. Fortunately for us technicians, human nature remains more or less constant and tends to react to similar situations in consistent ways. By studying the nature of previous market turning points, it's possible to develop some characteristics that can help to identify market tops and bottoms. Technical analysis is therefore based on the assumption that people will continue to make the same mistakes that they've made in the past. Human relationships are extremely complex and never repeat in identical combinations. The markets, which are a reflection of people in action, never duplicate their performance exactly. But the recurrence of similar characteristics is sufficient to enable technicians to identify juncture points, that is, when to buy and when to sell. In our approach, these characteristics represent the evidence, and the evidence is really the indicators and techniques we'll be covering in this and subsequent modules. All price movements have one thing in common. They are a reflection of the trend in the hopes, fears, knowledge, optimism, and greed of market participants. The sum total of these emotions is expressed in the price level, which, as the legendary analyst Garfield Drew noted when referring to stocks, is that they never sell for what they're worth, but for what people think they're worth. This statement applies to any freely traded security. It's important to understand that market participants look ahead, anticipate future developments, and take action now. If you're on the railroad tracks and see a train coming, is it likely you're going to wait until the last moment before getting off the tracks? No. You anticipate that the train is going to run over you and you get off right away. Market participants are the same. The difference is that not all participants get the news at the same time. Some get the news from a different angle, and different people have different attitudes towards the same anticipated developments. For example, if you're an investor and anticipate that some forthcoming avenues will create a short-term reaction on an ongoing bull market, you probably won't take any action. On the other hand, if you're a highly leveraged short-term trader, you'd be foolish not to sell. Otherwise, you'd lose all your profit. This discounting mechanism is the reason that markets bottom when the news is bad and peak when it's good. At such points of extreme emotional activity, participants have already factored today's headlines into the price and begun to anticipate tomorrow's headlines. This is all very well and good, but it would be of little use except for the fact that prices move in trends. Once a trend begins, it tends to perpetuate. One principle that emerges from our definition of technical analysis and the weight of the evidence approach is that it should be assumed that once a new trend emerges, it's still in force until enough indicators have given trend reversal signals. Technical analysis does not promise that you can identify the top or the bottom, merely the area of the top and the area of the bottom. Two key points before we wrap up this introductory segment. First, because prices and their trends are determined by psychology, the principles of interpreting any indicator are identical for all securities, whether we're looking at LME copper in London, Sony Corporation in Japan, or the 30-year government yield in New York. I'm often asked if I've ever written a book on technical analysis for Forex, and I always reply no. And that's because the principles of interpreting currency price action are absolutely identical to those for analyzing any other freely traded security. Second, the principles of interpreting any indicator are identical for all time frames, and that would apply just as much to a monthly chart of Google as a 5-minute one for LinkedIn. The only difference is that the same phenomenon that appears on a monthly chart will have substantially greater implications for the new trend, both in terms of time and magnitude, than if it had appeared on an intraday chart. I'll be showing you lots of examples of differing time frames, so if you're a day trader, don't get discouraged if I show you a monthly chart of Microsoft to demonstrate a point. Neither should you long-term folks get upset if I show you an hourly chart of Walmart. Before we proceed to examine some of the indicators, I think it's a good idea to take a look at some of the principal methods of plotting the data.